we are ready to go. All right, I think we're good to go. All right, people. What's happening? What is happening? This is not, let's look at a longer term chart and see what's up. I mean, these are, look, here's 15.5. We're right on the market, 15.5. Here's 19 plus. Here's 4,500. Remember, we were trying to get to 4,400 not very long ago. It's way down here, miles above that. Here's the 35,000 line on the Dow. We are hitting some resistance. We're finally making it to a point where, oh dear, where's the selling programs? Let's see. Why am I tired today? I don't know. Didn't think I slept plenty last night. Anywho, all right. So let's see the futures. Meanwhile, the dollar has been smacked down. Oh, what kind of chart is that? So that's like way too long term. All right. So the dollar, August 25th. Well, I mean, frankly, 2 days ago, but the dollar was at 104.20. And now it's at 103.10. So that's down 1%. So the dollar's down 1%. And the Dow doesn't matter. The S&P matters. And the S&P is from 40. Well, let's say really from the 4,400 line. And now we're at 45.25. So that's at 125. And what is 125 divided by 4,400? Andrew's son, come on, quick math, very important. 125 divided by 4,400 is 2.8%. So basically double what the dollar went down. So that's pretty normal as a 2 times effect from the dollar. So we haven't had much here. Also, you have to realize that if the dollar goes down, oil goes up, natural gas, everything, you know, all the commodities go up basically. Here's the soft commodities. Cocoa went up, copper went up, everything priced in dollars, which is everything, goes up, right? And if everything priced in dollars goes up, then all the people who make those commodities go up, right? If you sell those commodities, if you're a copper miner or you sell corn or oats or cattle or whatever, your stock goes up even more. This is why the effect is double with the dollar, because all the people who sell it, like Rio Tinto or Barrick Gold, or or warehouses selling their trees or whatever, everything goes up that you sell, and therefore the investors go, ooh, look, the price of copper went up, the price of wheat went up, the price of oil went up, so my stock's going to make more money. That's how you get that snowballing effect, right? All these commodity producers, price goes up when the dollar goes down, and all the people who import, which is for at least half the S&P's revenue, right? They import products from other countries, so their revenues, they get a positive spin when the dollar gets weaker. I'm sorry, no. If you import, it's bad. If you export, sorry, it's exporting. 60% of the S&P sales are exports. So if you're exporting and the dollar gets weaker, that means the foreign currency you take in converts to more dollars. Kind of weird, right? So, you know, the dollar's weaker, you're shipping a car overseas, that car is priced in, you know, let's say you're selling the car for, I can't even do the math, let's say 200,000 yen. I think that'd be $20,000, so 400,000 yen, whatever it works out to. Sounds like a lot of money, but it's not. So let's say you're selling a car for 400,000 yen, and that was at 100 yen to the dollar, that was $40,000, but now it's 95 yen to the dollar. Oh, I'm sorry, now it's 105 yen to the dollar. No, wait. It's so hard to do the math. I'm trying to think how the situation works. Okay, if the dollar gets weak, if it was 400,000 yen for the car, and the dollar gets weaker, now you're going to get less yen. There it is. Okay, so you're going to get less yen. Or I'm sorry, you don't get less yen though. It's a 400,000 yen car. It doesn't, there you go. That's the trick. You should get less yen, but you don't because the car is the car. They were going to sell the car for 400,000 yen. They're still selling it for 400,000 yen, but when you get the 400,000 yen, it's worth more dollars than it was. That's how it works. God, that's confusing. This is why people do not understand the global economy, because you have to think in like twists and turns of what goes on. So in other words, what I'm saying with no visual aids, let's look at currencies here. Where is the yen? There's the yen. Not that it's making any big bounces, but oh, ow, so ugly. Is it really 68 yen for a dollar? I had 100 in my head. Here's how old I am. It was, well, actually it was 100. No, that's the yen, sorry. It was 100 a couple of years ago before COVID. Wow, and now it's down to 68 yen for a dollar. That is awful. That's almost as bad as Canada, where it's 73 Canadian dollars for 73 Canadian dollars to a dollar, 73 Canadian cents to the dollar. So I'm sorry, 73. This is 68 yen for a dollar. No, it's not. It's reciprocal. So 1 Canadian dollar is 73 cents. But with the yen, it's going to be 130 yen to the dollar, I think. And we can figure that out by, well, I don't want to say figure it out. It's not really fair to say we can figure it out. We can figure it out by asking Google and saying, how many yen to the dollar? How many yen to the dollar? 1 Japanese yen. So 1 US dollar, 146 yen. That's crazy. That currency is in big trouble. Oh, speaking of which, that's another thing you're gonna hear. You're hearing a lot of this now, I'm sure. There's a lot of people predicting that this, and this is a monthly chart, right? So from 95 to 68, they're predicting this is going to happen to the dollar, and the dollar is no longer going to be a global currency. Now, the difference is that the dollar is used in so many transactions globally. It's probably 80-something% of all global transactions are done in dollars. So when they talk about no longer using the dollar, because they're saying right now the BRICS countries that just admitted new members are going to stop using the dollar and move towards a new gold-backed currency. But the reality of doing that is one thing to do it. It's another thing to get people to adopt it and use it. Look at Bitcoin, right? How long has Bitcoin been around? And has anybody out there? And please, like, I know nobody participates, but please, like, if you have, tell me, what Bitcoin transaction have you actually done? Or has anybody you know ever actually bought anything with Bitcoin? And that's been out there. They've been pushing it as hard as they can. But I will tell you that I have been involved in some potential Bitcoin trades. Not one of them actually worked out. Because in order for one party to transfer a large amount, and a large amount is like 1,000 Bitcoin, because 1,000 Bitcoin are they what? They're $27,000 right now. So 1,000 Bitcoin is $27 million. It's a decent transaction. So if you want to transfer $27 million in Bitcoin to somebody who wants to give you $27 million for 1,000 Bitcoin, right? You have to show them your wallet and let them verify that it's got 1,000 Bitcoins in it. They easily can show you their bank account that shows they have $27 million, right? Any reputable bank, you can print a statement that says, I have $27 million in my bank. In Bitcoin, that's not how it works. You have to let them peek inside your wallet, get your wallet address, and test it with a transfer just to verify that there is money in the account. They can't actually tell how much, but they can have some basic idea that you've got Bitcoin in a wallet and you are able to transfer from that wallet. Once they do that, now you've got to start setting up escrow accounts where the lawyer will take the Bitcoin, and you got to trust the lawyer because it's a large escrow account. And the lawyer is going to take the Bitcoin and you're going to transfer it. And everybody wants a fee for doing all this stuff. And so now you're paying fees to transferring money, not the $250 they charge you at the bank, but like 1%, 2% fees to transfer money. Not only that, though, but you can't trade dollars for Bitcoins. Very few people want dollars for Bitcoins. They want something called Tether, which is the stable coins, which are USDT. So first you're asking the person who has $27 million to convert the $27 million to USDT. Then you can transfer the USDT to a wallet. But I can't transfer Bitcoin to your wallet. I can't transfer dollars to your wallet. Bitcoin wallets only hold other coins. So now you want to get a coin like USDT, which is a dollar-backed coin, and that sounds reasonable. But now the person who has the dollars has to now pay a fee to convert to USDT, and a fee being again 1%, 2% to do that. This is all madness, right? You can have 4% friction cost, 2% on each side, in order to make a simple money transfer. How often can you do that before you haven't got any money left? It's laborious and time consuming and full of theft and mistrust. And it does, and you can't do it right away, and you have to transfer in bits and whatever. You can't just walk into a car dealership and pay with Bitcoin, even if they were crazy enough to take it. And then the other thing is with the fluctuation of Bitcoin. Here day to day, I mean, here's the dollar going up 4% between July, mid-July to late August. So let's say 5-6 weeks. Here's the dollar going up 5%. That's a pretty big move, but all the currencies did it because if the dollar moves, everybody else moves against it anyway. So the dollar went up 5%. But if you look at Bitcoin, and let's give it so say 6 months. So Bitcoin was up at $30,000 in July, and it fell down to $26,000. So that's 4,000. So 4,000 divided by 30,000. That's not how it works. 4,000 divided by is 13.3%. But of course, you've got that same issue with the dollar, right? The dollar got stronger, Bitcoin got weaker, because Bitcoin is also priced in dollars. Everything's priced in dollars. Get it? That's the theme of the show. So to some extent, the fall in Bitcoin had nothing to do with anything but the drop in dollars. Now, just today or yesterday, what was this thing? Binance launches, Binance. No, it wasn't Binance. Okay, sorry. Wasn't Bitcoin either, at least I'll say it. Robinhood's Bitcoin stash surpasses 3 billion. Third biggest holder of Bitcoin is Robinhood. What is this the news? There's the news. Anyway, there's U.S. court pays away for the first oh, there you go. And it was great. It was Grayscale, not Binance. So the courts are kind of leaning towards allowing these Bitcoin ETFs. So once they do that, of course, you're creating more of a market for Bitcoin and creating more demand. That gave Bitcoin a quick pop in the last few days, right here. So we went back from 26 all the way to almost 28, and now we're settling back at 27. That's where that pop came from. So despite the dollar. Now, that's great for Coinbase, who we have. We have some Coinbase stock. Because Coinbase is one of the largest Bitcoin trading platforms. So they're popping back up again. And we have a conservative play on them. Anything over 100 is going to be great for us. So we'll see, but I like Coinbase a lot. Coinbase, you need these trading desks. You can't just, again, it goes back to you can't just go to the store and use your Bitcoin. You need these trading platforms to legitimize it. It's going to be a long, hard road. So anyway, meanwhile, Bitcoin's been around for how many years? It's more than a decade of Bitcoin, and we're still nowhere. So when you hear that these currencies are going to replace the dollar, it's like, yeah, sure, okay, long after you're dead. Even if they come up with a really good solution and it works and it's more efficient and it's better and whatever they want to say about it, it still isn't going to replace the dollar. Not until you say, would you rather be paid in Bitcoin? That's really what the answer is at the end of the day. Would you rather be paid in Bitcoin than dollars? And if you can't say yes to that, then the same question is going to apply to whatever global bullshit strategy there is. Remember the Krugerrand? The Krugerrand was a gold coin. That's a gold standard. It was accepted around the world. The Krugerrand was 1 ounce of gold and would always be 1 ounce of gold. And it was your hedge against inflation. Yeah, I'm sure you all had one at some point. It was a hedge against inflation. It was government assured and government backed. Other countries started minting gold coins as well. That should have been the standard. But even that, would I rather get paid in Krugerrands or would I rather get paid in dollars? Well, if I get paid in dollars, I can go to the 7-Eleven and give them my dollars. If I get paid in a Krugerrand, most people aren't going to take it. Even though it is exactly 1 ounce of gold, it's worth exactly what 1 ounce of gold is worth. But how is that better? It's like having a $2,000 bill in your pocket that nobody can break. What is the point of this gold coin? How is it better than having dollars? If something isn't better than a dollar, it's not going to replace the dollar. And better means a lot of things. First of all, you have to have an entire banking system that accepts it. Because if I can't borrow the dollars, or if I can't borrow Bitcoin from the bank and get a reasonable Bitcoin return of interest weighed against my Bitcoin salary, so I can use my Bitcoins to buy food at the grocery store, then what am I doing with it? And they said, well, you should have it's this easy electronic thing, and you don't need to worry about money, blah, blah, blah. It's like, well, I got a credit card for that. I don't give a crap. I go to the credit. Now, if my boss would put the money directly into my credit card, and they have that. They do electronic transfers to your bank, essentially, and you could have a debit card for that. But you could have your money put directly into your debit card, and then you go spend it. That you can do with dollars. How is Bitcoin better? How is messing around with these stupid Bitcoins better than using a debit card? I'm taking money out of a bank account, I'm putting it into another bank account, I'm giving it to the store merchant. How is that better? You can't, you can't just call something a replacement. It's not like it's not like kids making up rules of a game. People have to adopt it and people have to use it and people have to trust it. In El Salvador, they're trying to get people to adopt Bitcoin. Let's see, who would know that? Bing would know that, hopefully. Let's ask Bing how it's going. Where is Bing? Oh dear, I lost my Bing thing. What are you? Oh, okay, there it is. New topic. As of August 2023, how is the adoption of Bitcoin going in El Salvador? Big push from the government to make Bitcoin their standard thingies. Sorry, something went wrong. Okay, let's try refresh. All right, so September 21, 2 years ago, they made Bitcoin legal tender. So the government has been promoting and supporting the use of Bitcoin through various initiatives such as Bitcoin Embassy in Texas. I don't even know about that. They have a $1 billion Bitcoin bond for infrastructure projects, distributing $30 worth of Bitcoin. They're giving every citizen $30 of Bitcoin to spend. Public opinion has been divided, with some people embracing it, others rejecting it as risky, volatile, unnecessary experiment. According to the survey conducted by the Central American University, 67%, 2 years later, 67% are against the use of it, and only 25% said they're in favor. That took 2 years with the government backing Bitcoin. The international community has also expressed concerns and criticism, citing issues of money laundering, tax evasion, financial stability, human rights. The Senate introduced a bill that requires the Department of State to submit a report on the impact of adoption in El Salvador, including its effects on democracy, corruption, and security. The International Monetary Fund warned that El Salvador's move could pose significant legal economic challenges, urged the country to adopt a prudent policy. In summary, the adoption, ongoing evolving process, many challenges, blah, blah, blah. So here you are, 2 years down the road, the government of El Salvador not just pushing in Bitcoin, but investing $1 billion here and giving every single citizen $30 Bitcoin dollars. And again, that's where it's said, right? They distribute $30 worth of Bitcoin. $30 being the operative word. Okay, you haven't gotten rid of the dollar if you have to explain what you did in dollars. It is so hard to change a currency. It's so hard to change a payment system. Oh, I didn't mean to do that. Open back up. Anyway, all right, so what else is going on? Oh, and then we got the hurricane. I don't know how that's doing, but it's not terrible. It's just barely a category 3 as it hit the land, which is, being in Florida, you have to be pretty good at what category. It's a big difference because apparently 130, well, think about it, 130 mile an hour wind is like driving down the highway and putting your hand out the window, right? It's a little less than that, but you get the idea. It's like, it's going to push your arms back. It's pretty strong, but it's not going to like kill anybody. 150, when you get up to the higher categories, 150, 180 mile an hour wind, that feels like it's burning through your flesh. And not only that, though, but if you get hit by something, at any speed, it hurts. But if you get hit by objects in a 150 mile an hour hurricane, you're going to get damaged. You really can't go outside when the winds get over 120 miles an hour. Obviously not as much as going 120, but you're really hitting the point at which your flesh will really kind of squish with anything that actually hits it. It's really bad. It's really hard. There's unbelievable amounts of rain. And it's tracking up over Tallahassee. So Ron DeSantis gets to have it all over his house. It's going right up over Tallahassee, and it's going up here, and here's Georgia, and here's unfortunately Charleston, which is a wonderful old city, and it's a shame if it gets damaged. And then all the way up the coast, that's a lot of rain. And the big problem is they don't know this because they've never had the water be this warm before. They don't know what's actually going to happen. It could actually head north because if it's going to keep, see, it's strong, it gets weaker, but then it gets stronger again. As soon as it hits water again, it's going to suck up more warm air and more water, and it could actually get bigger and change course. So going to be interesting. It'll suck if it really heads north. That would be hit major populations. But they think it's going to go out to sea. But even this bit here, $80 billion worth of damage just by doing that. If it went straight north, if it goes this way, you'd be looking at $200-300 billion worth of damage from one storm. So we talked about the hurricane before. You can see how like totally flattened. This is what, the Bahamas, I think. Yeah, this is the Bahamas. It's like a tornado on a much wider scale. It's when when these storms are that strong, you've got big problems. I mean, there's Charleston, like right dead center. That's sad for them. And here's Tallahassee. That's our capital in Florida. But look at this. This has already been happening. Well, I'm sorry, this is last year. But last year we had 3. Is it 3? Nope. Wait, that's 1. Oh, I'm sorry. Well, I don't know. These guys I don't think were so big, but we had this Fiona thing. We had Ian, and they had Noru down here. Oh, I'm sorry, and that one, Tonandol. So they had a bunch in September, a bunch of major cyclones. I said lumber is a good buy. It's up a little bit today. You got to think about what happens after the hurricane. You got to start rebuilding, right? Now they throw all kinds of money into the area. People have to run out to Home Depot and Lowe's, and they buy a lot of wood, and they buy a lot of other supplies. And we talked about that and drilled them and said, well, first of all, Lowe's, Home Depot are often good buys at this time. I don't think either one of them are particularly cheap, though. Here's Lowe's. So Lowe's is 131 billion. They make 8 billion a year. That's pretty damn good, though. So their PE is quite low, low for Lowe's. About 16 times earnings. So even though they've been on a slow, steady increase, it's basically deserved. The only disturbing thing about Lowe's, though, is they actually have less sales than they had before. They were 89, 96, 97, right? They dropped back to 88, 89. So probably this is due to like stimulus and people spending money, during the stimulus times and whatever. But they dropped back to what probably you would say is a sustainable path from where they were in 2020. Now they're at 88, 89. You're probably going to see this kind of growth, 88, 89, 90. The profits are 8. But as long as the profits are 8, as long as they're under $160 billion, they're a good buy. Because they do have growth and they are a nice, steady business. It's just not a huge immediate catalyst, but it's a good company. I don't like the 36 billion in debt. That's what bothers me about it. Let me look at Home Depot, who's their obvious competitor. And remember, they used to both compete with Sears, and Sears is gone now. It's good for them too. There's no competition. Home Depot has got a higher market cap, but much more profit. They got more than double the profit at 15 billion. Or basically exactly double the profit at 15 billion. But they are more than doubling the market cap. So not as good of a buy. Lowe's is a better buy. Home Depot, though, numbers are going up and up as opposed to Lowe's, which went down. So Lowe's numbers dropped a bit. Home Depot's pretty steadily climbing. So they're really kicking ass. They've got more debt, but they're much bigger, so their debt is actually less in proportion to the company for Lowe's. But in the end, you know, they were not they were not to me thrilling choices. So I looked at Lowe's. I decided lumber itself is a good buy. Because lumber should head back to about $600 as they start using it to rebuild, and that at the when you make you make $27.50 per point. So if it goes up 15 points from here, and you make $27.50 per point, that's $2,337 per contract. Generac is a generator company. We like them a lot. And so rather than buy the stock, so what happens? I was in this situation up north because we had a lot of power lines getting knocked down. So if it was summer, winter, whenever, up at my house in Jersey, we had a lot of times we would lose power for like half a day, 1 day. You know, if the power lines went down, they had to send crews out and do this and that, whatever nonsense. And it happened like way too often, like 3 times a year we'd lose power. It really ticked me off. So they get, you know, there comes to be a last straw. Now, if I lost power for 3 days or 4 days, which happened to us once, that was a major storm that hit us. But if you lose power for 3 or 4 days, like people will in this hurricane, it's a lot of times the last straw, and you suddenly say, you know what? Suddenly $3,000-$4,000 for a generator doesn't seem like a big amount of money anymore. Like to make sure you actually have power when there's some kind of storm. So that's where Generac kind of wins customers. People just decide, okay, I'm going to buy this generator. They get pretty backed up. They're like Boeing. They've got a big backlog of orders, but people are always focused on their current sales, which is the wrong way to look at this company. But I got no problem buying Generac for the long term. It frankly could go in the income portfolios. It stays pretty much in a channel most of the time. So in other words, we started off last year owning the Generac. Let's say back here we bought the 2025 100-150 spread, right? So we played this channel. Now, during this time, if we just kept selling the 125 calls, we would have been successful, loss, success, loss, success. So mostly successful. We would have sold a lot of calls at $125, made a lot of money. How would that look if we look at the options now? Where is this? Okay, so if we go to 2025 and let's say we take the 100s that are $40 and we sell the 150s, which are $19, let's say. All right, so that's gonna be $21 for the spread. But then I could also sell the 100 puts for 14, and that would make my net $7. So for net 7, I have a $50 spread that is $18 in the money. And then against that spread, since it's so wide, I can sell the November 125 calls for $8, $8.50 actually. All right, so we did that math. How can we do that math that I show you? I'll just sketch it out over here. Chat. Here we go. So if we go, this is for GNRC. So the so let's say 5 short puts at 14, 10 long 10 2025 100 150 spreads at 21. So that's going to be $21,000 for 10 spreads. And that's going to be, and look right here without margin, without doing anything else, that's a good spread. It's 21 bucks on a $50 spread. That's a good price. You're going to make $50 at 150. We're currently at 118, right? So these are $18 in the money, and you're only paying net 21 for the spread. You get all the upside of Generac for a $3 premium. That's very worth playing. Doesn't matter if you do anything else. That right there is a no margin, perfectly good play. Now, what we do though is we take $7,000 off the net price by selling the puts. And what does selling the puts do? Selling the puts is promising. Here's a bracket. Selling the puts is promising that if Generac is below, oh, I didn't write the number, short 100 puts. If Generac is below $100 between now and 2025, this guy has the right, the guy who's paying me $14, has the right to assign me 500 shares, 100 per contract, has the right to assign me 500 shares of Generac for $100. So I'm pledging to spend $50,000 on Generac stock. That's my promise. So that's my commitment. So my commitment is basically one allocation block in my portfolio to purchase Generac stock. Now the margin requirement on such a thing, whoops, wrong year. So here's the 100 puts, and we sell them, and we sell 5. We're not selling 10. So we sell 5. And look at this, the net buying power effect is $2,800. Doesn't cost me anything to do this, not in a portfolio margin account. It cost me $2,800 to make that sale. Of course, I'm going to make that sale rather than spend $7,000. I'm sorry. See, I'm collecting $7,000. I'm selling for blah, blah, blah. So I'm collecting $7,000. I can lose $42,950, so I can get assigned the stock at $50,000, but I collected $7,000, so I can't lose more than $43,000 basically. My net buying power effect is $2,800. So in a portfolio margin account, it doesn't cost me anything to sell these puts. So why wouldn't I? I have no reason not to do that unless I really don't want Generac. If I would like to own Generac stock down the road, I got no reason not to make that sale. Now, what does that sale do though? So now instead of my net $21, all right, I'm taking $7,000 away from that. That makes it $14,000. So now effectively I have the 100-150 spread at $14,000. That means my break even is now 114. If it's above 100 and I don't get assigned, my break, and 114 is obviously above 100 anyway, my break even is $114. The puts would still expire worthless, and $14 is my break even over 100. Anything over that is profit. So now I could make up to $36, which is 200% per contract. If I left this at $21, I could make 30, which is 150%. So instead of making 150% of 50, I would now make, what'd I say? It's now 14, and I make 36. It's more like 250%. So my potential profit goes from 150% to 250%. But really, that's a weird way. It's the reality of the math of it. But what am I really doing? I'm really going to where I could have made $29,000 on just the vertical spread, right? So just this spread here can make $29,000. I'm spending $2,000 in margin, so my cash requirement is lower. So instead now I can make $35,000. Not tricky. That's the real difference. The real difference isn't 150%, 250%. The real difference is I could have made 29,000. Now I can make 35,000. I haven't changed the play. I have the same target. I sold the $100 puts. My worst case scenario is being assigned 500 shares at $100. That's my worst case. Now, if I lose, don't forget we are putting net 14 into this. So if I lose the 14,000 that we're putting into the trade, that's 36,000 actually, 36. If I lose the $14,000 we're putting into the trade, then I end up getting assigned at it'd be 500, it's 500,000 is 28. So basically I'm paying 128. So that's my real risk, is it being assigned the 500 shares at what effectively would be $128 a share, because I'd be losing the 14,000. Now, what's the trick of that? Don't lose the $14,000. Don't sit there and watch it dwindle away. You're paying, you realize you're paying $21,000 for it. It's worth $21,000 now. It has to drop 33% to go to $14,000. At that point, you need to seriously reevaluate the trade. Now, when will that happen? This is what the delta is for. The net delta of the 100-150 spread is 73 is the delta here. And on the 150, the delta is 47. So 73 minus 47 is 26. My net delta is 26. So that means for every $4, that GNRC drops, I will then lose $1 on my spread. That is $21. So if I'm going to lose $7 on my spread and drop to 14, it's going to be 7 times 4 is $28 less. So that's going to be basically 90 bucks. So for me to lose 33% on my spread, not counting time decay starts getting me over after a while too. But it's an immediate drop. I'm not going to lose 33% unless Generac drops all the way down to 128. Massive drop. I'm sorry, 98. I was like not 128, 90. So all I have to do is basically, if Generac falls below 100, I have to seriously reevaluate my trade. So the premise of my trade is it holds 100. That's also when my put would get in trouble. How much money would my put be if Generac drops to 100? Well, it's 119 now. So I'm selling the 100 put. And if it drops $20, then theoretically it should be around the price of the 120 put, which is $23.50. So at the $100 line, I'll be down $9 on the put, and I'll be down what do we say, $7, and we're down $7 on the thing. So then I'll be down. Where is that spread? Here it is. All right, so if this drops down and I lose $9,000, so minus $9,000 at 100, and this one we decided was going to be what did we say it was going to be? Oh, that one, sorry, that one's $9,000 or $9 anyway. So it's $9. So that one will be minus 4,500 because there's only 5 of them. All right, and this spread we said would drop to 14, so we'd lose 7, so we minus 7,000 on this one. All right, so we're going to lose $11,000 at 100. So really, All right, so really, that's what we feel is our realistic risk. So I've got an upside potential of $36,000 because we're including the puts. If I don't include the puts, I'm risking $7,000 to make $29,000. So in other words, I'm going to stop. I'm either going to stop or I'm going to change the trade. If I change the trade, it's a new trade. Still losing the money, but I'm going to change the trade and roll my positions and move it to another trade or double down or whatever. Whatever I do, it's effectively a new position, carrying the loss into the new position, but it's a new position. That's a different decision I'm making going forward. But my decision right now is I'm saying to myself, okay, at about $100, if we can't hold $100, I'm going to pull the plug. So at the moment, if I just had the bull call spread, I could make $29,000, and I'm risking $7,000 if I pull the plug at 100. So my risk reward is 4 to 1. That means I can make plays like this 4 times and get 3 of them wrong, and I'll still break even. That makes it a good play. I'm better than 50-50, therefore I will make money. Maybe not on this one, but I will make money over the long haul because I'm better than 50-50 at picking stocks. I'm actually more like 70. So if I'm 70% right, I'm going to make a freaking fortune, which is how our portfolios work. If we are 50% right, we are going to make good money because that's how our portfolios work. Because being right and making 400% twice versus being wrong and losing 100% twice is going to net you quite a lot of money. You're going to be well ahead of the game. That's 50-50. If you're 75-25, it's ridiculous. You don't even care about the losses. So that's with no margin. Adding the margin brings me to 11,000, but I'm going to make 36. So I'm risking 11,000 to make 36,000. That's still 3 to 1. If I feel strongly about it, I do it. Now, in this situation, what did we actually decide? We actually decided, this gets radical, we're just, where to go? There it is. We are just selling the puts at the moment because we want to see how this works out. So if it works out, great. If it doesn't work out, great, because we don't care. We're not going to lose much money. I'm going to risk $4,000 to make $7,000. And you say, well, that's not even as good a thing. It's not even 2 to 1. But I'm only selling the puts, and if I get assigned the puts, my net is all the way down at $86. That's almost a 30% discount to where we are now. So my worst case now, it's not about the money that I coulda, woulda, shoulda made. It's about the fact that my worst case scenario is I get to enter GNRC, which is a stock we like, at 120, but I get to enter it at $86. So my worst case scenario sounds great. Would I like to buy 500 shares of GNRC for $86? Oh yeah. How much is GNRC now? It's 118. So would I like to buy 500 shares for $86? Yes, please. Can I have them now? No, you can't, but I'll give you $7,000 for making the promise. I'm going to pay you $14 per short put for promising to buy GNRC at 100. Therefore, you are netting in for $86. That's something I can do right now. The spread, on the other hand, is not really going to get away from me, okay? Again, because of that net delta that doesn't change it much, I may, if Generac pops over 125 on the hurricane, I may have to take the 110, 160 spread, or the 110, or I do the 110, 150 spread, let's say. Let's say you take a $40 spread instead of the $50 spread. I don't care. I'm still going to spend a very small net amount of money, and I'm going to be I'll be deeper in the money, and I'll be on a better path to ultimately hitting my goal. So I can take a very small chance now. It's almost like a placeholder, but it has a high probability of taking off. Now, so either Generac's going to go down 20%, and I'm going to get to buy a position starting at $86. That'll make this much cheaper. Maybe I'll have the 80-130 spread instead, right? So I have a much better position with this if it goes lower, and I'll be happy to buy more of these or roll them or whatever. If Generac is flat, this trade will always be available to me, and I've already got this part. If Generac goes up, then this part becomes basically guaranteed free 7,000 that I can apply to any spread I decide to take going forward. Frankly, the worst thing that can happen to me in this trade is Generac pops over 130, which is only 10% higher than it is now. If Generac pops over 130, I may not want to take a higher spread. It may become less attractive to me to take the spread, and all we're going to do is just have this poor little trade, and it's going to make $7,000 very boring. But that's the flexibility you get with options. I'm making a very, very small commitment here with very low risk. This isn't a high risk one either. Putting them together is perfectly fine. But you can't make a gigantic trade out of everything you do. Every single thing we have a notion to do can't be a trade. So in this case, and we're not even putting in the long-term portfolio, we're putting in the short-term portfolio, because all I want to do in the short-term portfolio is get an income. So what I'm saying is, in the short-term portfolio, if it goes well, I just drop $7,000 worth of cash in the short-term portfolio. If it's flat, I drop $7,000 worth of cash in the short-term portfolio. If it goes down less than 30%, I drop $7,000 worth of cash in the short-term portfolio, or some cash anyway. If it goes down, though, what I'm probably going to do is I won't take a loss in the short-term portfolio. I will roll the position to the long-term portfolio, take the loss over there. The short-term portfolio gets the money back from the long-term portfolio. So I'm effectively selling my bad. It's like the Fed. The long-term portfolio is like the Fed, and the short-term portfolio is like a bank that gets bailed out. So the short-term portfolio was hoping to make $7,000. It doesn't work out. It sells the put back to the long-term portfolio, who overpays for it, makes the short-term portfolio whole again, because that's where my hedge money is, right? And then the long-term portfolio goes, yummy, I get to buy GNRC for net 86. And then it's going to say, okay, since GNRC is now cheap, I will initiate a long position. Short-term portfolio doesn't have any interest in carrying 2025 GNRC play, but it does like making cash off of short puts. So that's how we play it. And by the way, again, I'm 70 to 75% right, so that hardly ever happens. It's more likely we just close it in the short-term portfolio, because we usually make money on all the short puts we do. Because how obvious is that, though? Right? Like, who wants to bet me even right now? I bet anybody who wants to bet $100 right now that we make the money on the GNRC play, I'll take that bet. Because it's a simple trade. It's based on some very firm logic. It's based on the fact that it's an undervalued stock that $100 should hold. And we're at 86. We're down below the lowest it's been in years. And it's a good, solid company. Talked about some other companies that are potential. Of them, they all have a problem. Like they have a debt problem, they have a profit problem. They all have something wrong with them. So basically, there were none I particularly liked, except that then I was looking at MPX, Marine Products. And Marine Products is a cute little company. They're only $541 million, small cap stock. They make $45 million, which is 12x. They don't have any debt. They got 43 million sitting in cash. They don't have long-term options, though. They only go out until March, which isn't terrible, but it's, you can't turn much into it. But I did like the play. So given that, though, I didn't put it in a portfolio, but I just said, okay, if you want to play it, you sell the 1750 puts. Oh, I didn't do a chart for them. Well, anyway, so it doesn't matter. Listen, let me futures chart. All right, so we're playing them saying that this is a fair value, and they're just getting a little rejection off of 18. And of course, they're getting rejection off of 18. They started it at 10. So they're making a run from 10 to 20. And what are the pullbacks from 10 to 20? It's a $10 run. You're going to have $2 pullback. So that's going to be the weak retrace. 16 is a strong retrace. 14 is a strong bounce line from 10 to 20. So 14 is probably going to hold. Okay, you see how they have support here, support. Couldn't get over, right? Then they went way down, then back here, couldn't get over 14. So 14 is a very significant line. And they're coming back out. So probably in this range, but they're consolidating for a move up, okay? And the point being that when you look at this hurricane, not that, there it is. When you look at this hurricane, a lot of people here own boats and a lot of people here own boats. A lot of boat damage. And MPX is a boat company. They fix boats. They have parts for boats. They do all the stuff that people need for boats. So, what was it? That's why I put this up here. So this is the Chinese symbol for crisis. The word crisis in Chinese is made up of two symbols. One is called danger. One is danger, and one is opportunity. That's what a crisis is: danger and opportunity. And that's what this is. You know, you're having a crisis. Is there a way you can make money on this crisis? And it turns out that MPX is a very reasonably priced stock. And if we sell the $14.50 puts, I'm sorry, if we sell the $17.50 puts for $3, that comes in at $14.50. We think $14.50 is a very fair price. So we're happy to sell 10 of those. We're only committing to 14,500, I'm sorry, net 14,500 in ownership. We're buying 20 of the March 10.15. So already in the money. It's at 14 something. We're already in the money with the 10.15 spread. We're paying $3 for the $5 spread. That works out to $6,000 in this case. But we also sold the puts, so our net is $3,000 on a $15,000 spread. Oh, it's not a $15,000 spread. It's actually a $10,000 spread. Sorry. It's only a $5 spread. I was going to do 30 and then I changed my mind. So that's a mistake. I'm going to fix that right now. How come nobody sees these things? Changes you made may not be saved. Did I do it? No, here it is. La da 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 da. And that is 3,000 on the $10,000 spread. The upside potential at 1750 is $7,000. And that is still, what is that? Calculator. So it is 7 divided by 3 is 233%. There you go. Now I feel better. Yeah, but it's 233% in 6 months, which is pretty good. Yeah, 400% in 6 months was too much. All right. So again, we feel that the value of MPX at 14 is a fair value for the stock. And again, like I said, you've got almost 10% of the valuation is in cash. They're on a bad day today. I wonder why. I wonder why today it's having a bad day. Take a look at that. Wow, all positive articles. Marine products still move high. Marine products still strong. Marine products, power behind the boat business, blah, blah, blah. Today, they have their earnings call on August 10th. Interesting. Let's say something about them here. Marine products minus 6%. No particular reason. Interesting. Where's Yahoo? Percent. 12 days ago. There's nothing here. Not that this is reliable at all, but I'm kind of like trying to figure out what's going on here. Oh, on CNBC halftime, they tagged the stock incorrectly. That was August 15th, though. That's got nothing to do with what's going on today. La-da-da. Why is marine products MPX down so much this week? See if he has a clue. I wish he would not bring up COVID every time. They're so stuck on COVID because their learning model ended in September 21 when COVID was like the most important thing. Second quarter revenue, 116 was up 21% year over year. Net income was increased 43% year over year. Company reported a decline in gross margin, a teeny tiny decline in gross margin. Higher labor and material costs. Additionally, company's earnings per share missed consensus 43. These results may have disappointed analyst thing. On August 23rd, DA Davis initiated coverage with neutral price target of 16, implying a downside potential at the time. The analyst cited the company's strong brand recognition, loyal customer base, but also noted the challenges of rising input costs. So basically, he sees this due to higher labor and material costs, and he makes his report a couple of weeks later based on this particular thing and picks the company apart. This rating may have influenced some investors to sell or avoid buying the shares. Yep. Nothing, no particular reason, nothing, no good reason. It's just an opportunity for us to jump in and buy, frankly. So we love that. We love when stocks go down for like little or no reason. Ooh, Brendan had that yen thing right on the button. Could have saved me some time. Better than ChatGPT. JC says, now that we are in hurricane season, please discuss the natural gas outlook and the outlook for UNG. How high do you imagine UNG might trade in the coming year? Thank you. By the way, any thoughts on NEP as an alternative energy play? It is 50 and it's just come off a 52-week low at 44. Okay, one thing at a time. Let's see. Let's talk about natural gas. We just had this whole discussion in chat, so I don't want to get into it because we just had a whole, we just talked about natural gas in chat. Was it today or yesterday? No, it was yesterday. had extensive conversation. Hang on, we'll go use that one, and we'll say Phil's posts. Oh, well, they are Phil's posts. Okay, we'll get there eventually. Well, a lot of things have the word UNG in it. Okay, so Uganda here had said, talked about UNG, and I talked about UNG. Oh, I see, okay. So this is the key to what your question is, okay? The key factor normally affecting US natural gas is hurricanes, which shut down the production in the fall and spike prices. So if you're looking, you have to think, I said to him, if he's not happy with the way it's performing. So I said, if you're looking to get out, take advantage of when there is a spike. Otherwise, you may not get another chance to get out. The catalysts aren't what they used to be, though. This is key. The problem, or the problem, it's a problem. The problem is we've gone gung-ho to pump up our natural gas production because we are building all these liquefied natural gas terminals that export, okay? So it used to be that if there was a hurricane, natural gas in its regular state is not really, you can't put it on a ship. It doesn't make any sense to put a ship full of gas on the ocean because it doesn't carry enough gas to make it worth selling. The cost of transport makes it not worth it. So all countries would be basically landlocked. If you don't have pipelines to transport the gas, your gas is basically landlocked and you can only trade what you can only sell what you can use in your country or in the immediate area, wherever you can reach by pipeline. That's how gas has been for many years. Therefore, if a hurricane would knock out production, you are only buying your natural gas from your local production. Therefore, the prices would immediately spike. There's a very direct connection. Now we have all these terminals that compress the gas 600 times, massive, massive compression of the gas. So you have 600 times compressed gas going across the water. So it's like sending 600 ships full of gas at once. That's a lot of gas to export. It makes it worthwhile to export the gas. But the dynamics have now changed tremendously, okay? Because now we produce the gas locally, we compress it locally, which creates inventory locally. So now we have a lot of gas sitting around. We don't have, in a pipeline model, you basically have to use the gas. Whatever gas we produce, you use. If you don't use it, we have to encourage consumption. Otherwise, basically, they have to bleed the pipelines and just get the gas out of them. You can't overfill the gas. So in Europe, they were paying companies to take the gas and put it in their own storage rather than shut down the pipelines. That was several years ago that happened. So the dynamic has changed. So this is now much more complex than it used to be because now gas goes from the well to the pipeline to the compressor to storage where the compressor is. So now we have much, much, much more gas in storage so that if production is cut back, we just take some of the gas out of storage. Instead of shipping it out, we might take some of the gas out of storage. We have very, very little chance of running out of gas now because we store it in all these places. Then the ships go out. Now, here's the thing. There are two different kind of things that can happen. One is you can shut down production, but like I said, we already have a massive amount of storage of natural gas that we've never had before. So if you shut down production, unless it's a serious shutdown, not a couple of days just because a hurricane goes by, then you may not get that spike in natural gas that we used to get because we don't have that immediate need for all this gas. We're just basically building it up to ship it. We're sending it to the compressor compresses it, goes in storage, the ship comes by, picks up the storage, and it goes. That's how it works. But what happens if the ships that are supposed to be taking the gas out of the country are delayed or blocked by a hurricane? Now you have the exact opposite problem. Now you've got all this gas that's being produced, that is being backed up, that isn't being taken away by the ships. And it's just building and building and building. And we got to have somebody take this freaking gas out of the country, or we're going to be swimming in it. So the dynamics are no longer simple, and you can't just say, oh, it's hurricane season, it's good time for natural gas. For all we know, so let's take a look. US LNG terminals. There you go. So look at this. This is where the hurricane is. The hurricane's going through here. There's two natural gas. Oh, it's not. They're not even built yet. I mean, I don't know when this is from, but so under construction, operational. So we have so few operational. It's got to be an old map though. We got to have more operational than that. Really? It's the EIA? 2016. I knew it. That's nonsense. Pools. You know, Google really should know that you don't care about a 6-year-old map. All right. So it's not about checking your sources. You got to check your dates to make sure the source is current and so on and so forth. I don't know when this is from. Wow. Who's operational? Existing. Red is existing. Everything else is proposed. What? Eh. Oh my God. How are you supposed to figure anything out? This is the worst. Withdrawn, suspended, disapproved. Okay, well, that's all right. We got something there. Approved expansion. Proposed. Approved. U.S. LNG export and re-export terminals. All right, so these are the existing ones. Okay, so that's where we are. So the hurricane is going here. So it's this one's in danger of shutdown. This one's in danger of shutdown. This one's in danger of shutdown. And if you have a hurricane over here, it's worse. The drills, the rigs are over here in this area. A lot of them. I mean, obviously we have shale gas. We have Marcel. We have shale over here. We have shale up here. So you know the land production doesn't generally get killed by a hurricane. It's mostly this that they have to evacuate these platforms all around the Gulf. And if they evacuate the platforms around the Gulf, that curtails production considerably. But like I said, the thing is, all these guys have tons of gas in storage, so they can always send it back out the pipes to whoever needs it and cover any kind of shortage. We never had that before. But what's worse is if a hurricane comes in this part of the Gulf, it's going to stop any of these natural gas tankers from leaving with the supply. That will trap the gas here, and then we will have much more gas than we need in America. So you need a perfect storm that hits the Gulf, doesn't knock out the production, doesn't knock out the compression and export of natural gas. So you really need a hurricane that kind of goes up here. It has to go up here, still going to hit this thing. Has to go up here and go across up here, basically. That's what you need to raise the price of natural gas. Anything else, you have more of a danger. A storm that goes this way or the storm we're having now, which is cutting right up here. So it's shutting these platforms down, but it's also shutting down this terminal, and maybe this terminal. So there's more of a balancing act. It's not such a direct cause and effect. You can no longer use the old model. And I know it's always hard for investors when something that you've been doing for 20 years changes. It's very, very difficult to wrap your head around the fact that it's just not the way it was anymore. But it isn't. And we talked about that when we had a conversation with our with Claude the AI, right? So we were talking about Keynes. And Keynes was a great economist, and he says, when my information changes, I alter my conclusion. You know, and I said to him, I was saying to the AI, that's really important. You got to always be open to new information coming in. It is so hard, and that's why most people, most analysts, most big traders on Wall Street, people who run firms, what they know is what they learned in college and with their first training program. Once you get promoted and move up the ladder, you tend to be more into the management things and learning the new stuff about the thing. You don't sit there learning trading the way you do. And that's one of the reasons I never went to work for Wall Street, is because they don't want you to keep learning. They don't want you to keep studying the markets. They want you to start doing other stuff. They want you to teach other people how to study the market and so on and so forth, but you don't get to do it because you don't have time for that kind of stuff anymore. And that's what I enjoy, is studying the markets and learning. I enjoy new stuff happening and figuring out how to make money off it. That's fun. That's a part of the job I do like, so don't take that away from me. But anyway, so you've got to adapt your situation to the facts, and in this particular case, the facts have changed. So that's that for UNG. So we have that whole discussion yesterday about UNG, and oh, I'm sorry, and then oh, way to go. And then we asked Shellbot what he thought. And he said, this was important. U.S. natural gas production in 2023 is between 102 and 109 per day. This is up when it used to be 94. So historically 94, now 105. So it's up 10%. So we're making 10 billion cubic feet more per day, but exports, which never existed back then, exports are now 12 to 48 billion a day, and that's because it's not because they can't figure it out, it's because it depends on how many ships are leaving on any given day. You know, ships come in and go out, they come in and go out. It's not like they don't come in and go out like oil ships, which is every single day. They come in, this terminal has, 3 this week, another terminal has 2 this week, another terminal has 3. They're not every day, everything the same. On some days, all 3 terminals will have a ship going out the same day, boom, 48. So that's where it fluctuates. But they range between 12 to 15. So let's say it's somewhere like 20 something goes out per day. That's a lot more than we produce. That's more than the increase in production. We're now sending out a ton of natural gas. So it's worse for the supply demand situation. You want more, you want gas out of the country to have higher prices. It's more likely the gas gets trapped in the country, because if these ships can't take it out, you're making more gas anyway. So that dynamic is going to be very weird for the next 10 years as we build out. You saw all those proposed natural gas terminals. So for another decade now, we'll be building all these natural gas terminals. And as we build more natural gas terminals, we will increase production. And sometimes there'll be more terminals and more exports than the production can keep up with. Sometimes there'll be more production than the terminals can keep up with. And especially because we saw one of the biggest terminals got shut down at the beginning of the year. That's what spiked prices at the beginning of the year, was the terminal got shut down. And again, same problem, right? Just like a hurricane, it trapped the gas in the US, and and the prices dropped after. First they went up, but then they went down. Because the net effect of shutting down a terminal is actually bad. It's, you know, and people are trained to buy when they hear that there's a problem. The kind of problem you have if you shut down a natural gas terminal is all that gas has nowhere to go. Very different situation than what we're used to. So it makes it a much trickier investment. Now we want to look at NEP. I think I've used up enough of your time though at this point. Let's see. So see how they're doing. So Nextra is just under $5 billion at 50. And they only make $200 million. That's 25 times earnings. I'm done. What was your take on them? By the way, what are your thoughts of NEP as an alternate energy play? It is at 50 and it's just come off a 52-week low at 44. Yeah, I don't care. This is still a terrible price. What is going on with these people? They're 36 times earnings. I wouldn't pay that. What on earth did they do that I would want to pay that money? You know, Nextra Energy is a partnership to acquire, manage, contracted clean energy projects. The company owns interest in blah, 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 blah. Who cares? You can acquire all the projects you want. If they don't make money, why do I care? And I'll tell you that because clean energy projects they're very long payouts. I work on some of these things. How's their balance sheet? Look at that debt. The debt going up and up and up. $5 billion in debt for a $5 billion company. Wow. I'm working closely. I'm consulting with a company called Atlas Energy, and it's a great program. If you want to make steady 20% returns, investing in alternate energy, investing in solar in their case, investing in solar energy, it's great. Conceptually, you build the project. The project costs a certain amount of money. You're going to get a return. The return is going to net you 20% a year for 20 years. That's a good return. But that's all it is. So these guys have, and your upfront costs are going to kill you if you're not getting outside financing or something. I don't know if they are, but they're making 10%. They're dropping 10% to the bottom line. That's not even good, but they, you know, maybe they are using outside investors and they're giving them the, you know, half the money. But that's going to be normal. They're not going to jump up to some massive number. For them to get to, they have to make $500 million to be at a PE of 10. They have to get to at their $5 billion. They have to get to 250 million to be at a PE of 20. And that would mean that this has to get up to $25 billion, $2.5 billion, which is 50% higher than it is now. They're not growing at a rate. Their growth rate is about 10%. So it's going to take them 3-4 years, and that's assuming they can make the profits hold up before they're going to get to a level that makes sense. It's a slow, boring way to invest. And frankly, you can take your cash and put it into these solar projects, and you will get income tax credits and things like that that are going to make you a much better. You get depreciation. If you invest in the project yourself, you have depreciation and you have income tax credits. There's a 30% income tax credit that comes directly off your income taxes. That's part of the Biden program. And the other part of the Biden program is 85% accelerated depreciation over the first 5 years, and most of it's in the first year. So you're getting back almost all the money you put in if you have use of a depreciation deduction. That's the thing, you have to have a use of depreciation deduction. But if you can use that depreciation deduction, and you can use the income tax credit, which means you just made money and you can use the income tax credit, you will then get something that looks more like a 70% return over 5 years, and then you can flip the project to a regular investor who's going to make 20% after that, but you'll make the bulk of the money yourself on investment tax credits and whatever. These guys aren't doing any of that from what it looks like. Or maybe they did it here. Maybe this is why they had such a big bump over here, but now they've used up all their their pre-money, and now they've got to start new projects again. But there's nothing special about this at all. I don't even know why you're mentioning it, honestly. It's just not a thing I'd be putting money into. There's way better ways to put money into alt energy than these guys. Like SunPower, who are so stupidly cheap. Now let's talk about that. So SunPower is solar manufacturer installer. They're down to 1.3 billion at 731. So they were devastatingly down, and now they bounced a teeny tiny bit. They're down below 7. Now they're back up. 7, I think, is really the floor. Now, their PE ratio is 61, but the reason it's they're building up something. And so this is always tricky because it's 61 right now because they're losing money. And 2023 is done for them. They're into 2024. So they expect to make money next year, but they're going to make 48, 50 million next year. Not, I mean, whatever you call it, fiscal year. So they'll make 50 million in the next fiscal year. 50 million into 1.3 is 22. So they're much better here than on paper, and the growth is there. You see, if these numbers weren't going up, if the top line revenues weren't going up, I'd be worried, but they are. And they made, forget this, they made 50 million here, and they made 22 million here, and they made 50 million here, and they keep reinvesting and building up their infrastructure because they're playing a long haul game on this thing. But more to the point, they've got, you know, almost 2 billion in solid revenues here, whereas these guys, they've got 1.5 billion. They're being valued at $5 billion. Suncor is being valued at $1.3 billion. Suncor's got more sales. So, you know, when you look at a company like this, you got to look at what they're actually doing. Look at the debt. The debt is only, this TTM's not debt. This debt is $9 million. They paid down their debt while this was going on too. So the cash flow is there. This is just a company that's investing in itself in order to make money down the road. So nobody has any faith at all that they're going to turn it around. And so the stock is like dwindling at a bottom. These are the kind of stocks that you can make a fortune on. But, you know, you have to have faith in what they can do, and you have to understand they can execute. You know, they spun off Nextra Energy. Not Nextra, sorry, Maxtor. Maxon, that's what they call it. Maxon. They spun off Maxon, which was part of SunPower. Now Maxon is their supplier. Now, we originally, as SunPower owners, when they spun off, we owned all that Maxon stock. So we had two companies for the price of one. SunPower, of course, and that's why you have this. Oh, that was a spinoff. That's where all that money came from. This is when they spun off Maxon. They got a big, huge payday for that. That allowed them to put money into stuff that boosted their revenues and let them concentrate on the solar panels, not the manufacturing. But that then knocked down their margins, right? Because now they're buying from Maxon. They're buying the solar panel from something they used to own. And they have to just sort of rebuild it, but that was all part of the plan. But it's like a 5-year plan, and American investors do not like 5-year plans. They don't like 5-month plans because it goes past the end of the quarter. You know, you can take advantage of that. You can take advantage of so many things because American traders don't like long-term plans. They don't like cyclical stocks. Really, literally anything that doesn't work in the next 3 months is something people dump. And it's so crazy. It's like it makes so many companies just a ridiculously great value. Look at US Steel, right? They're a cyclical stock. and they were in a down cycle. So now they got bidders. People, people have an interest in buying them are saying, yeah, I'll give you cash for that. What, $6 billion, $7 billion for US Steel? They make $1 billion a year. They used to make more than that. Okay, they made 4 billion in 2021. They made 2.5 billion in 2022. Now the cycle is down again. Why? China slowed down, so on and so forth, right? But they're capable of making that. And these, by the way, you can't go by this. This was COVID. But if you have a longer term chart, you'll see they go from $1 billion, 2 billion. They can make, that's unusual, but they make about 2 billion in a good year, and they can lose 500 million in a bad year. But overall, they're going to make $1 billion, $1.5 billion a year. And if you multiply that by even 10 times, you're at $15 billion in valuation, and currently they're trading at $7 billion. It's just silly. But people don't know how to value a cyclical stock. Look at their debt, 473 million in debt. They paid off all this debt while they were doing that. So that's why they have multiple bids now, because a lot of people are saying that stock's so cheap, I just want to buy the whole company. And it's going to be hard for Mittal to get the company because they're foreign, and in reality, we don't really want the only U.S. steel company left to, or Schnitzer, but you don't really want the only, the biggest steel company left to go to foreigners. And so Cleveland Cliffs is a good contender to buy them. That's another one I've always liked, and I've always liked them because they're a U.S.-based iron ore pellet manufacturer. So for them, it's a great fit. It makes sense for them, and it consolidates into one large American steel company. It'll be great. So we shall see. How's the market holding up? Ooh, a little bit of a pullback. Still green, not very green, not what you want to have on August 30th, but we have one more day to end the month, so we'll see. We will see what happens. Oh, all right. If there's no more questions, we're gonna get towards a wrap up here. Let's see what else is happening. Let's see if the news is exciting. Latest news, Open Text goes ex-dividend, oil price forecast raised at Barclays. Ugh, really? This is that pre-holiday bullshit, right? They're trying to just words to get oil back up to 83-ish. We're going to short it, though. Look, it's looking good for our prediction. I said it'd be 83 into the holiday. Here's our goal. And if we hit it, we're going to be in good shape. Oh, the inventory report. We talked about this last week, and the prediction was we'd have a draw. This is August 18th. Okay, so last month, oil inventories decreased by 6 million barrels. Gasoline increased a little bit, and distillates increased a little bit too. So 2.5 and 6.1. So not big. But as we said last week, coming into the holiday week, what's going to happen? People who are going places, go to fill up their tanks. So they're driving somewhere for the holiday weekend, they fill up their tanks. That oil, that oil, gasoline, whatever, is in their tanks. Hasn't been used. See, that's the funny thing about the word demand, all right? Because filling up your car today ahead of the weekend, when you would have normally filled up your car on Friday anyway, for a normal weekend, but now you got a holiday weekend. So people are like, okay, let's go make sure we got gas. And they go and get their gas, they fill it up, their tank is full of gas. Right? You don't half fill your tank ahead of a holiday weekend, right? You don't say, oh, I'm gonna just put in $10. No, you fill your tank up ahead of the holiday weekend, you're gonna drive somewhere. Now, you drive somewhere. If it's far, obviously you're gonna buy more gas, so on and so forth. It's not gonna change the equation of what you were doing anyway. If you don't drive that far, though, if you are just driving to a destination and you don't drive more than you thought and you come back, maybe next week you don't buy gas. All you did was push your consumption forward, right? If you're making a big trip, yeah, you're going to use the gas. If you're not making a big trip, though, maybe you just bought gas because you're going to do a lot of stuff this weekend back and forth, and you're buying gas now to be ahead of things. Whatever it is, there's a pre-holiday week and there's a post-holiday week of gas buying. People buy gas before they leave on a trip, and when they come back from the trip, they buy gas to fill their tank back up. But either way, here's the trick. Either way, there's a full tank. So you're going to get a couple of weeks of what is what they call high demand. But the high demand means you've moved the gas from your major tankers that they're measuring with the EIA report, right? They're measuring the major tankers. You've moved the gas from there to 200 something million cars with their tanks. So 200 million cars times 20-gallon tanks is 4 billion gallons of gas divided by 42 is 95 million barrels of gas. Okay, so that's almost, it's almost a week's supply, right? So 95 million barrels of gas is a full tank. Now, obviously, people usually have a half a tank. So maybe the difference is only 40 million barrels of gas or whatever, but either way, it's a huge amount of gasoline swinging into tanks, gas tanks. That's not measured in these reports. In fact, the report tells you, they talk about demand, they talk about consumption, but it's not consumed if it's in your tank. You didn't go anywhere, you just filled up your tank. Until you go somewhere and use it, it's just a different inventory that's not being counted. Very, very big misconception of these kind of reports is not understanding there are other ways to store gasoline other than what's on this report. You don't count what's in the car. So this week, which ended the 25th, which was Friday or Saturday, Friday. So this one ended Friday, and crude oil imports, blah, 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 commercial crude. Okay, so commercial crude decreased by 10.6 million barrels. Blah, 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 blah. It's 3% below the 5-year average. So it's really right where it should be. Total motor gasoline decreased by nothing. Look at it, this is disappointing. 0.2 million barrels, we should have used more gas than that. And that's 5% below the average. Still, really nothing to be alarmed about. Finished gasoline inventories. Distillate fuel increased, but it's 15% below the average. But keep in mind that distillates is only 117 million. So when it says it's 15% below, that's only like 20 million below. We made up 1.2 million in 1 week. This is just a choice the refineries make. This is not a time of year when people need distillate, so it's not important to be making it now. And actually, if you look back at 2022, we were at 111 in 2022. We're at 117 now. We're definitely better than last year. Do they mention that? No, they don't mention that. And all other oils is another thing they don't count. All other oils went up 1.5 million barrels as well. So our imports went up. We went up from 2.7 to 2.9. Exports went down a little bit, using a little bit more fuel at home. And that's a big difference. But we're still sending out 4.2 times 7 is 28, 29 something. 29 million barrels being shipped out of the country every week, and more than a day's production, almost a day and a half. Price-wise, they've gotten the prices back to where they were last year, 382 last year, 381 now for the gasoline. Even though oil is significantly cheaper. Now it was 93, now it's 80. So the oil's cheaper, but they've got the gas up. So imagine what the refineries are making right now. The oil is more than 10% cheaper, but 10% would be 93 would be 84, and it's 80, so it's 15% cheaper. So the oil is 15% cheaper, but they're charging the same amount for the gasoline. Complete bullshit. No reason for this at all. Just ripping off the consumers. And not only that, though, they're exporting it. If they weren't exporting it, we'd have such a huge glut. But anyway, so that's where we are. So you have to understand that there's a whole place that people put oil. And just think about what you do with your family and so on and so forth. Coming to a holiday weekend, you fill up your tank. So this is a week when everybody fills up their tanks. And that's going to increase. So all that extra oil up to, what do we say, to at least 20 million barrels of oil are swinging from the normal places that they measure it, which is here, into your car. And that gives you a huge apparent draw. But the opposite is true on the way back, because on the way back, you had a full tank, now you're back to a half a tank. You're not really inclined to run back to the gas station, especially if the prices are high. People tend to wait. They wait till it comes down. So this is bullshit price. You know, I just paid this to fill it up. Now it's this. You have to take all these things into consideration when you look at these reports, and it's hard. It's hard because there's so many freaking things to think about. But you know, if you're going to be betting on it, you have to really take it into account. You can't just sort of randomly make the bets. So it's all going according to plan, though. That's a short story. As I said, it would hit about $83 for oil. And that oil is being driven by the gas demand. The gas demand is being driven by the holiday, and it's all priced too high into the holiday, and the whole thing's going to fall apart after the holiday when they don't get the kind of draw that they expected, because people still have gas in their tanks. They won't go to fill them up over the next they fill them up over the next couple of weeks normally like they used to. Won't have that kind of effect. Everybody's going to be disappointed, and everybody's going to sell over quote disappointing holiday demand, even though it's not, even though it's just normal holiday demand doing its normal thing. And again, you've got the issue of more efficient cars are on the road that get double the mileage, use half as much gas for the same trip. And every holiday, it's a bigger and bigger impact to the oil industry. There's more and more electric cars, more and more higher mileage cars, more and more people buying cars that have those EPA stickers that say 40 and 50 or 30 and 40. Nobody buys a new car anymore and says 20 miles a gallon. Almost pretty much doesn't exist. But every car being taken off the road is a 20 mile a gallon car. The cars being put on the road new are 30, 40, 50 mile per gallon cars. They're going to use half as much gas as the old cars. The electric cars use zero. You got to factor that in too. So if you're replacing, well, there's 16 million cars sold a year in the US, 16 million. All of them have better mileage than the cars that are being traded in. So 16 million new cars using half as much gas. So, and that's, you know, it's kind of, let's blend in electric and say it's all overall half as much gas. And 16 million cars drive 15,000 miles divided by 20 miles per gallon divided by 42. That's 285 million barrels of gasoline. And so if the new cars are using half of that, they're saving 100 and something million barrels. And all right, so wait, let's divide that by 2. That's what they're saving, and divide that by 52 weeks. 2.5 million barrels a week. Okay, it's not a big part of our fleet because we got 300 million freaking cars, but it adds up every year. So this year, we're using 2.5 million barrels less per week. Next year, 5 million barrels less per week. The year after that, 7.5 million barrels less. The year after that, 10 million barrels less. Okay, this is a weekly number. We have a 10 million barrel draw of crude, although still we're right in the 5-year average. We're exporting that crude. It's all bullshit, but the point is, even with that, we've got a 10 million, even though we're sending out 28, 30 million barrels worth of oil per week, even though we're exporting 30 million barrels, we only have a 10 million barrel draw. But we're going to make that up in 4 years by simply rolling our fleet over, and it stacks. So in other words, we're rolling 5% of our fleet over every year as we roll, and also the mileage every year is going up. So it's actually not even good for the auto industry that we're slowly rolling our fleet, because if we roll our fleet quickly, we'd roll our fleet at 30, 40, but we're rolling it over time, and over time it's going to be 50, 60 down the road. When you get a new car, it'll be 50, 60, not 30, 40. And then we're using 1/3 of the amount of gas that we were using in the old cars. That's what the oil industry is facing. That's why they are campaigning and lobbying and doing whatever they can to stop people from conserving energy and to stop people from coming up with alternate energy. They don't want any of this. It's going to destroy their industry. Their industry depends on this number. It depends on you using 20 million barrels a day. That's daily consumption in the US. Not really consumption, we're exporting it, but they need this to go. And you know why? They've got billions and billions and billions of barrels of oil in the ground. Their company's valuation is based, just like a gold miner with the gold, their company's valuation is based on the oil that's in the ground as much as anything. But if you're going to use less and less and less of it, then that oil has less and less value. And that's devastating. You're talking about these companies losing, 10, 20, 30% of their market caps in the next few years. Oil companies are bad investments right now. They really are. It's just a slow, steady death for that whole industry. Because one way or another, in 20, 30 years, we will not be using oil as a primary source of power. It'll be a very small source of power. It'll be more used for other stuff, and even plastics are under attack, which is the second biggest use of oils. That's under attack. So if we're not going to use it for transportation and we're not going to use it for materials, there's not going to be a lot of use for oil. It's going to be a very low value material down the road. Either that, or we'll all be dead because we keep using oil like idiots and we destroy the planet. So either way, the oil industry is over in 30 years. Whether it takes humanity with it or not, that's what we're looking at as far as the difference goes. So keep that in mind when you start saying, oh, I like this energy company, whatever. But like I said, the alt energies, they don't have great payments. It's like buying a utility company. So you can't say, oh, that's better just because we're going to alt energy. It's a whole transition for the economy that you got to stay on top of. Oh, all right, that's longer than I thought. All right, so otherwise, it's a holiday week. Everybody enjoy yourselves. I'm certainly not going to work much longer than 12 on Friday. I'm going to have fun. And we will do this again next week. All right, so take care, everybody. Thanks.